Welcome back. I'm sitting in for the birthday girl, Betty Kiptum. Let's go straight into the business. And Central Bank of Kenya Governor Dr. Patrick Njoroge is optimistic that dollar inflows from the World Bank as well as the IMF will lift Kenya's Forex reserves above the recommended level of 4 months of import cover. Since November of last year, the Forex reserves at the bank have been lower than the recommended ceiling.
There have been concerns about the stock of Forex at the central bank. A statement from the Monetary Policy Committee yesterday indicated that Kenya's Forex reserves had deteriorated for the second time in a row and was below the recommended 4 months of import cover. The central bank currently has $7.005 billion in Forex reserves, which is 3.92 months of import cover, down from $7.038 billion, representing 3.94 months of import cover in November last year. However, central bank governor says there's no cause for alarm yet.
We don't have any concerns there. We do expect that the cover will increase, and the reserves that we are holding remain adequate.
He says Kenya is expecting dollar inflows, which will lift the import cover above the recommended 4-month cover.
We also are looking at it looking forward, which is expected inflows that will be coming, and we have this programmed in our into the future. World Bank, there's amounts like 400 million US. The IMF will be coming again for a review, and once that review is completed, long before end June, we expect 300 million US, the equivalent of that, and also other external loans that have been discussed.
He projects the economy to expand 5.6% this year, supported by the services sector and recovery in the agriculture sector that had 2 bad years, with good rains and distribution of subsidized fertilizer.
It will decline by 0.3%, so -0. Our agriculture has therefore being sagging, and we do expect that there will be a rebound if we have normal conditions. So we are not hoping for floods and things like that, but having normal rainfall conditions in 2023, particularly the long rains.
Rice and sugar for 6 months will ease shortages, avert a food crisis, and reduce pressure on commodity prices.
Maize, what has been gazetted is like 27% of annual consumption, and rice is about 39% of annual consumption, and sugar is about 13% of annual consumption. So I'm making the point that this will actually have will assert a downward pressure on prices, but more generally on food inflation.
Wairi Mujenga for Prime Edition.